Alphabet stock is soaring in the last month while Meta stock is falling. Investors are asking me which one of these two stocks I like better right now at the new market prices. I'll answer that question in this video, comparing these two stocks across several important financial metrics and also sharing with you my valuation on these two stocks using my discounted cash flow valuation model. So let's take a look. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. So the first thing I wanted to compare these two on is revenue growth. And looking back a little over a decade, we noticed that Meta has grown its revenue at a larger compounded annual growth rate compared to Alphabet. Alphabet has grown its revenue from 66 billion up to 371 billion. That's good for a compounded annual growth rate of 18% in that time. Meanwhile, Meta has grown its revenue from 12.5 billion to 179 billion. That's good for a compounded annual growth rate of 29%. What's more, in the most recent quarter, Meta accelerated its revenue growth to 25%, while Alphabet's revenue growth rate was below 20%. In the near term, I expect Meta will generate better revenue growth than Alphabet because Meta's business is growing on a scale that's smaller than Alphabet. So it's a little bit easier for Meta to generate revenue growth, given that it's generating roughly $200 billion annualized revenue below where Alphabet is. And when you're at that large scale, it's more difficult to increase your revenue at those quicker rates. Just look at Alphabet's cloud computing segment, which is growing nearly 40%, compared to Amazon's cloud computing segment, which is growing nearly 20%. And again, that's a matter of scale because on an absolute basis, the number is quite large for Amazon and Alphabet, but on a percentage basis, Alphabet's growth rate looks better because it's starting from a smaller scale compared to Amazon in that particular segment. The next thing I wanted to compare these two on is the operating cash flow to sales ratio. And one thing I noticed is Meta's operating cash flow to sales ratio is significantly better than Alphabet, but they both have excellent operating cash flow to sales ratios, and they're improving in recent years. So Meta's operating cash flow to sales ratio came in at 57% in the most recent trailing 12-month period. This is among the best of any of the companies that I'm following in terms of this particular financial metric. Meta Platforms is among the leaders of this metric, regardless of industry size or scale. Alphabet at 39.3%, that's an excellent operating cash flow to sales ratio. It only looks bad because you're comparing it to one of the best in the world with Meta Platforms. Further, Alphabet since 2022 has been improving this metric, but looking back a decade, it's flat from 39.9 to 39.3, and similarly with Meta Platforms. And since 2022, it's improving, but since 2016, it's been flat. And the reason why it's improving since 2022, if you recall, that's when the central bank in the United States started increasing interest rates to fight inflation. And that's when companies and market participants started worrying about a recession in the United States. And so they started preparing for a recession by cutting costs. And that included slashing thousands of jobs from their ranks. And Meta Platforms and Alphabet were two of the companies that did the biggest job cuts and biggest cost cutting. And those cuts led to improving profitability in future years. Now, the next thing I wanted to compare is return on invested capital. And given the increased spending on capital expenditures for artificial intelligence, this is becoming a very important category for me when evaluating these large tech stocks because I want to see how good they are at allocating capital, their history of allocating capital, because they're all increasing their spending in this category by the tens of billions of dollars. So it's becoming a more important category than it was maybe in 2019 or 2020. And thankfully, Alphabet and Meta have really good returns on invested capital uh, numbers historically. Um, More recently, they're about equal with Alphabet slightly better at 28% compared to 27% for Meta. They both had volatility in this metric, no real upward trend for either of them, no real downward trend for either of them, just a volatile return on invested capital figure, but consistently above their weighted average cost of capital, right? The lowest for Alphabet in the last decade was 17.5%. That's still well above its weighted average cost of capital, which is closer to 10%. And then for Meta, the lowest it had is 21%. Again, well above its weighted average cost of capital, which is also around 10%. So these two are excellent in this regard, and no real trend upward. Those are the two things I noticed. Overall, I would give them a tie on this metric. So now that we looked at a lot of the performance metrics, let's get into valuation, starting with the forward price to earnings ratio. So they're trading at nearly identical valuations on the forward PE of around 26. Uh, this has not been the case going all the way back to 2021. They've fluctuated between trading at a premium valuation and a discount to each other. And a forward price to earnings of 26 is near the higher end of where these two have traded for over the previous 4 years, according to this valuation metric. So again, on this metric, I would give them a tie on the forward PE ratio because they're trading at nearly identical ratios. So I also like to look at valuation utilizing my proprietary discounted cash flow model. And according to this model, Alphabet stock is fairly valued. The intrinsic value per share I calculated is $290. Current market price is $289. Alphabet's weighted average cost of capital is 9.74%. As I mentioned, that's well below its return on invested capital. It has a ROIC to WACC ratio of close to 3 to 1, which is excellent. Meta Platforms, I calculated its intrinsic value per share at $853, and the current market price is $623. So according to my proprietary DCF model, Meta Platforms looks significantly undervalued. Its weighted average cost of capital is 10.77%, and its ROIC to WACC ratio is also close to 3 to 1, but it's less than the ROIC to WACC ratio for Alphabet because Alphabet has a slightly lower weighted average cost of capital. By the way, these charts that I've been pulling up for this video, I retrieved from fiscal.ai, my preferred data provider. There's a link in the description if you're interested in their service. So really close evaluation on these two companies, right? Meta had the better revenue growth, the better cash flow to sales ratio, and the cheaper valuation when measured by my DCF. Alphabet was close on return on invested capital and on the forward price to earnings ratio, but behind in the OCF and behind on revenue growth in the previous decade and in recent quarters. So it's a tough decision. It's a close decision. But if I had to pick just one of these two stocks to buy, I would pick Meta Platforms right now. Now, just for transparency, I own Alphabet stock, but I've owned Alphabet stock since 2020. I also had Alphabet stock rated as one of the best stocks to buy almost all year long until today, that is, where I downgraded Alphabet stock to a buy, down from being one of the best stocks to buy because the stock is already up over 50% year to date and the valuation is no longer cheap, as I shared with you. Now I think Alphabet stock is fairly valued. I still like both of these companies. I think they'll make great long-term investments. But if you're forced to pick one, I don't know why you would be, but if you're forced to just pick one, I think Meta Platforms is the better value right now. By the way, did you know about our exciting channel membership program? You get so much for less than $5 a month, including dozens of exclusive videos, access to exclusive research on over 100 stocks, and early access to many of my videos before everyone else sees them. Click that join button below to learn what this program is all about.